It's almost the 30th of June, halfway through 2024, and that means it's time to optimize your tax return. So in this video, we're going to be breaking down 7 tips to help you create more wealth and optimize your tax return rather than just claiming the maximum deductions. Now we're coming up to the 30th of June, the big end of financial year sales have started, and their key trick is to try and get you to spend more money than you need to. So the first tip is only spend money on what you actually need, not just what you want. Just because you can get a tax deduction doesn't mean you should go out there and spend your money. It takes a lot of time for people to save and build their wealth and create savings. So if these companies can entice you and spend more money than you need to, that's money that could be going into future investments to give you cash flow down the track. Now, if you do need a business phone or a laptop or some stationery, by all means go out there and use these sales to your advantage, but don't go out and spend more money than you need to. The second key tip is around cars and their write-offs. Aussies love their cars. We love our utes, our big trucks, our vans. People love spending money on cars. And the maximum car write-off in the 2023-2024 financial year is $68,108, which means if you buy a car over the $68,000 mark, you won't be able to claim a write-off for that vehicle over that value. Now, a lot of these car companies are going to have big end of financial year sales. It's time to get a great deal. Come down to the dealership. We'll give you a 2% finance. Don't you worry, buddy. You'll be looked after this weekend when you come down to Motorama. Cool guys. When you walk into those dealerships on the weekend and you sign up for a new vehicle, that car is depreciating in value. Now, yes, you can claim the depreciation on a car, whether you're a business owner or you're an employee using the car for work purposes, but it is depreciating. The car is devaluing over time. And what this means is you've put down $60,000, $70,000, $80,000 on this car. The max write-off is $68,000 in this financial year. And that means you can only depreciate up to $68,000 over, say, a 5-year period. The car is therefore devaluing, which means the resale of the car in 1, 2, 3, 5 years' time will be a lot less than what you paid for it initially. Now, in my opinion, cars are one of those things keeping most Australians poor. People update their cars every 1 to 3 years, they buy new cars, they depreciate heavily, they devalue, and it erodes their use of funds. Also, the debt attached to the cars can be crippling. It can stop you from borrowing and buying an investment property, for example, and it really hurts your borrowing capacity. So just beware of getting caught in a car debt trap. Now, to get the optimal outcome for car use, it's going to depend on the way you're employed. For business owners, buying a car under the limit of $68,000 and claiming that over a 5-year period is going to be optimal. You can then look to hold that car for, say, another 5 years and get more useful life out of that asset. For employees, generally make sure you're doing a logbook and claiming all the work-related expenses for your vehicle. If you can try and buy a car between, say, $10,000 to $60,000 as well, this is generally going to be the sweet spot in terms of the price point to get the biggest value in terms of the quality of car, and to make sure it's reliable and useful, and claim all the work-related expenses as well. Speaking of claiming expenses, make sure you also claim your work from home expenses. If you have a dedicated workspace, you need to buy equipment like phones or laptops or cameras in my case, you can claim all of those items if it's related to your work. Make sure you keep those receipts, take photos of them and send them to your email. It's a great way to track receipts, and jot them all down in a spreadsheet. There is an option to do the fixed rate method, which allows you to time 67 cents by the hours you worked during the financial year from home. But in most circumstances, taking your actual costs is likely to give you a greater deduction and help you maximize your tax return. Just be wary that the ATO is cracking down on work-related expenses at home, so make sure you can justify these. Tip number 4 is around superannuation. Now, if you've seen any of my videos before, and I am a chartered accountant, you might be surprised to find out that I'm not the biggest fan of superannuation. The reason is I can't touch those funds. Yes, there are schemes like the First Home Super Saver scheme, which allows people to salary sacrifice, draw that money out in a more tax-effective environment, and use those funds for a deposit on their own home. But for most other people, if you're not buying your first home and you're putting additional money into your super, you're not going to be able to access those funds until the ripe old age of 65. Now, I'm coming up on 30, would you believe? I'm turning 30 this year, and it's going to be a big year for me in terms of my birthday. But what this means is I'm about 35 years away from touching my super I want to be able to use my money before then. So I want to enjoy travel, time with my family, spending money on my health and fitness. There's a bunch of other areas I want to use my funds for rather than locking it away for the next 35 years. Now, it's great that the government incentivizes people, and it's great that we have super. I'm just not the biggest fan of it for my current wealth creation journey. If I was 50 or 55, I might feel very different about this. Or if I was earning over $180,000 in my tax returns, it might make sense for me to salary sacrifice further and maximize my concessional contributions into my super fund each year. So for those higher income earners or people close to their retirement, you should be maxing out your contribution caps, getting closer to the $27,500 cap that we have for 2023-24. But if you're a bit younger, say you're earning somewhere between $50,000 to $150,000, if you do the maths and you know that you can't touch that money for the next 20, 30, 40 years, then it's less likely for you to want to do additional contributions to top up what your employer is already putting in your super fund. Now, I'm not against super by any means. I just don't think it's optimal for younger people to do additional contributions if they're not going to be able to access those funds for a long time, and they could invest in their own personal wealth creation journey by investing in shares or in property, depending on their risk profile, and have access to those funds at a lot earlier stage. Tip number 5 is claiming depreciation on your property. If you're a property investor, you can employ a quantity surveyor to go out to your properties and do a depreciation schedule. They'll review the fixtures and fittings, and they'll even ask for when you've done some recent renovations on that property to get a complete view of what the condition of the home is, and then provide a detailed schedule which you can then hand to your accountant. This is going to help you maximize your tax deductions. It's going to allow you to claim depreciation against your rental income, including all of your other rental expenses, and help you make the most of negative gearing if you're in that current situation, which most people will be given the current interest rate environment that we're in. Now, speaking of depreciation for investors, you also need to be wary of capital gains tax and how this can affect your tax return in each financial year. What happens when you sell an asset is it then flows through to your marginal tax rates in your personal tax return. Emily and I have just gone through this. We recently sold one of our investment properties on the north side of Brisbane, located in a suburb called Everton Park. Now, in a future video, I'll break down a detailed capital gains tax calculation on that property so you can see the specific numbers. But at a high level, when you sell a property, you're going to take the sale proceeds, less your original cost base, and you're going to need to factor in other costs and depreciation in your capital gains tax calculations. Like we spoke about before, if you claim depreciation on your own home, this is actually going to reduce your cost base, meaning you'll pay more capital gains tax when you sell your investment property. And this is something investors fail to factor in to their calculations. For Emily and I, in terms of optimizing our tax returns, when we're selling a CGT asset, we want to also look at our personal income. Because when your capital gains tax is added in, even if you get a 50% discount because you've held the asset for more than 12 months, it still needs to be added into your personal tax return, which means you could be paying much higher tax rates. So what Emily and I are looking to do in our tax return in 2024 is to reduce some of the dividends we receive from our company because we have a capital gains tax event in the same financial year. Key tip number 7 is claiming a large amount of deductions and not showing enough income in your tax returns can actually result in you losing serviceability and not being able to buy the home you want or buy the investment properties that you're looking to acquire. When you go through the tax process and you sit down with your accountant and you look at the numbers, the tax that you claim can impact what the banks see when they look at your financials year on year. Most banks are going to look at 2 years of financials. And if you have one really strong year and a really weak year, this can actually really impact your serviceability. Even if you say to the bank, look, I've claimed a load of expenses or we spent a lot of capital in our business and that's why our tax returns are really low, the bank's going to take what you're telling the ATO as gospel, typically when they're looking at your serviceability calculators if you're a business owner. Now, it's a little bit different as a PAYG employee, as it's more going to depend on your salary, your total income, and your living expenses when it comes to your serviceability. But the concept is the same. Goes back to our first point, which is don't spend more money than you need to before the 30th of June just because you can get a tax write-off. It needs to be a smart business decision. Whether you're a business owner and you're wanting to claim those expenses, but you've got to be aware of your serviceability, Or you're a PAYG employee and you're looking at your living costs and your work claim expenses, but you wanted to save as much money as possible to build up your deposits and show the bank that you have serviceability to acquire more assets. For me, it's not about maximizing the tax deductions in my returns. It's about playing the long game and looking at the wealth creation strategy overall, which is why I think you should optimize your tax return in 2024. Now, if you're looking to buy a property here in Southeast Queensland, whether it's your own home or an investment property, make sure you head over to purposeproperty.com.au to book in a free chat with myself. We're going to sit down, we're going to talk about your situation, talk about how we can optimize your wealth creation journey and look to grow towards the future, and leave some time at the end for some questions. So head over to purposeproperty.com.au to book in that session. Before you go, if you want to see a recent tax template video, click this video over here.